Judging by this year's market returns in gold, it seems like a no brainer that it should be in everyone's portfolio. But is that really the case? To find out if gold is right for your portfolio and also what I'm personally considering, hit that subscribe button and join me today, right here in the red zone. The commonly cited reasons for adding gold to a portfolio include: first, it can be a hedge against inflation and currency depreciation. Second, portfolio diversification. And finally, capital preservation. The best recent study I found, called Understanding Gold by Erb and Harvey, helps explain in detail gold's history and offers explanations on recent price movements. The link to read the study in detail is in the description, but I've pulled out about 8 of the 35 charts in that study to just hit some of the main points that may point us to next steps for our own portfolios. First up is Exhibit 2. The takeaway from this chart is in the title, that in the short term, inflation does not drive the 10-year return for gold. So, although gold may be a long term hedge against inflation, for example, an often cited Roman officer's wage in gold from 2,000 years ago is roughly the equivalent to a US Army officer's wages if they were paid in gold today. But in the short term of our investment lifetimes, gold as an inflation hedge is more of a coin flip. Next up is Exhibit 3. Takeaway here is that gold has been both positively and negatively correlated with US stock returns since 1985. Sometimes it's positively correlated, meaning it moves in the same direction, and sometimes it's negatively correlated. But notice how often the correlation is relatively small, with an average of only negative 2.5%. This tells us that gold prices move independently and that gold is best suited as a portfolio diversifier historically. This chart tells the same story and goes back to 1975. Notice that there is no real pattern. There's no line we could draw that would predict, even close prediction, stock price movements based upon gold movements and vice versa. There's just no correlation to be found. I like this next chart because it shows various major stock market drawdowns and how gold performed during the same time period. Gold was up 8 out of 11 times. Now we're starting to get into what we might expect going forward, or at least more recent history, and that was with the introduction of the ETF, that basically allowed the retail investor, or the majority of you watching, to hold gold without having to get a storage facility, insurance, and figure out how to trade solid gold coins or bars. The inflection upward is fairly pronounced. But our next chart implies that phenomenon may have run its course, as we see a step function increase that implies that the financialization of gold with the introduction of the ETF has permanently set the value of the underlying asset higher. But obviously, ETFs aren't behind the current run up in price we've seen in the last few years. Enter both China and Russia. The reason sanctions can be effective foreign policy tools is that the reserve world currency remains the US dollar, and therefore countries face consequences for behavior that goes against the general world order norms. In order to pursue policies outside those norms, to avoid sanctions, the most effective in a dollar based system, you need a competitive currency and currency system, and legitimizing that currency through holding traditional value stores such as gold. Since 2022, we've seen large central bank buying of gold, particularly from Russia and China, toward achieving the end of rendering US economic power less effective. Although we have the factors of financialization, central bank buying, and stability seeking investors who are nervous about current market valuations, all pushing the price of gold higher, history from 1975 so far has told us that high real prices of gold are associated with lower expected real returns in the next 10 years. Now, the authors of the study don't necessarily expect significant declines, as we are trending more on the green line, the post launch ETF world, rather than the more historical blue line. But that is assuming this time is different. So, overall, what did I take from this study? First, gold might help or might not help in my investing timeline with respect to inflation. Second, Gold will likely retain its value during most, but not all, stock market related shocks. And finally, gold will probably be lower or relatively flat 10 years from now, but it could still have more room to run to even get to an all time high. In summary, diversification seems to me to be the primary reason to add gold to a portfolio, and for most retail investors in the form of an ETF. How much depends on your strategy and investing timeline. For those in the accumulation phase with several decades ahead of them, I don't see much of a historical case to invest in gold, as this year it's been up big, but over the past 20 years of its fantastic run, you did much better just being in the S&P 500. For red zone investors, those of us who are a few years before or just after retiring, I think it really depends on your strategy to generate income in retirement. If you plan to sell assets in retirement, then an allocation to gold makes sense, as although it's volatile, it's an asset that's not correlated with stocks. If that is your strategy to sell the pile of assets you've accumulated to live in retirement, then I suggest you take a look at this portfolio design made popular recently by Frank Vasquez, where he allocates 16% of the overall portfolio to gold. Frank's research indicates that the safe withdrawal rate from a portfolio constructed with assets like those shown, in addition to their allocations, is around 5%, rather than a 50 stock, 50 bond allocation of only 4%. Now, if, however, your plan is to invest in assets that pay you back in the form of dividends, rents, distributions, or interest payments to provide your own paycheck in retirement, then gold doesn't seem necessary at this particular point in time. And if you're trying to diversify now, you could be doing so near an all time high, where we might see a flat or negative 10-year return. So here's what I'm doing. My overall retirement income plan is blended, but is heavily skewed in the beginning to rely on income producing assets, and gold doesn't pay you anything. The good news for me is that there are ETFs that use an option strategy that pay you back cash from your investment in that yellow rock sitting in someone else's storage. So, covered call ETFs are how I plan to gain some minimal exposure to this asset class. NEOS's Gold High Income ETF, ticker symbol IAUI, yields about 12% and writes out of the money call options based on its exposure to exchange traded products that have a direct exposure to gold. It was launched earlier this year, so we don't really know how well this ETF performs outside of the gold bull market. Next up, ticker symbol IGLD targets a consistent level of income of about 3.85% above the 30-day T bill rate. And true to its goals, it's currently yielding just over 7.5%. It invests in flex options that reference the performance of the largest gold based ETF, ticker symbol GLD. Of note, this fund pays 11 smaller dividends throughout the year and then generally has a high payout in the month of December. Next up from Curve is their Gold Enhanced Income ETF, ticker symbol KGLD, that yields about 12% and, like IAUI, writes options on gold ETPs. But its option strategy is much more complicated. Like AUI, also, it's a new fund that launched this year, so we don't really know how well this one will perform over the long term either. Of note, Curve also offers KSLV, which is a covered call fund for silver if gold itself is not enough precious metal diversification for your portfolio. So, what is your take on gold? Do you hold physical gold or do you use an ETF? Or do you have a covered call ETF instead? If you're interested in other diversification ideas and assets that provide income, then check out this episode that I put together on real estate investment trusts. Until then, I'll see you next time right here in the red zone.